Hello students, how are you? Hello students, how are you? I hope you're all fine and I'm finding you in best of your health. So we'll be starting in a few minutes, in a minute or two. So till the last class, we had done 27 uh, objective type questions and were working on earnings per share in the last class, right? So now we'll move further. We are left with some questions on earnings per share. Let's complete it first and then move on to the next accounting standard, which is IS 28, IS 21, sorry. So let's continue now. So let's start question number 28 on earnings per share. In this question, they are asking for the previous year's earnings per share. So what they are asking for the restated earnings per share figure for the comparative purpose, the last year's EPS. So as I said, if a right issue or a bonus issue takes place, what happens? We have to adjust the ordinary shares outstanding which were present prior to the bonus or the right issue. So the adjustment fraction was applied to what? It was applied to the outstanding shares prior to the right or the bonus issue. So obviously last year's shares will have to be adjusted. So if the last year's shares increase, then the last year's EPS will also decline. So when bonus issue takes place or right issue takes place, both of the current year's EPS will also fall due to the increase in shares and to that adjustment fraction, and the previous year will have to be restated. We have already quoted and we have already made the EPS public in the past year. So that's why the word restated has been used. Restated means that we are restating it, we are stating it again. So let's calculate the previous year's EPS now. So EPS is present. Previous year's EPS is given in the question. So if you see, the last year's EPS was 81 cents. Now, what adjustment we have to make? We do not have to calculate the whole of the EPS again, right? So please note, we do not have to calculate the whole of the EPS again. We just have to apply the adjustment fraction to the EPS. Now, how will we apply it? Let's check. So first of all, we will calculate the theoretical ex-right price. Okay, the formula for restated EPS is as follows. Formula for restated EPS in case of right issue is last year's EPS multiplied by the theoretical X right price divided by the come right price. Now this is reverse of the normal adjustment fraction. Now if you remember the adjustment fraction, what was it? It was theoretical X right price was in the denominator, but over here it is in the numerator. So you just have to calculate the same adjustment fraction, but you have to put it upside down. Agreed? So previously, see, our adjustment fraction taken in the previous example, the question number 26. If you look at it, our adjustment fraction was come right price divided by theoretical X right price, right? This was our adjustment fraction. But now it is reversed. Theoretical X right price is appearing in the numerator now. So let's first calculate the theoretical extra price and then calculate the restated EPS. Okay. So the theoretical ex-right price, the right issue fraction was 1 for 3 right issue. So there were 2 existing shares there were 3 existing shares and one more was issued, right? Now for the theoretical ex-right price, you need to know the market price before the right issue. So the market price before the right issue was 2.2. So you need to multiply 3 with the market price before the right issue, right? And then the right issue took place and the right issue price was 1.6. So multiply the one share issued as right at 1.6, and this makes 1.6. So sum these two up, this makes 8.2. This is the total value of the 4 shares now. So total shares now are 4 and 8.2 is the value. So now theoretical X right price is equal to 8.2 divided by 4. This makes 2.05. So now the adjustment fraction of yours for the restated EPS will be taken upside down. The last year's EPS was 81 cents. So take 81 cents, multiply it by the theoretical ex-right price 2.05 and divide it by 2.2, which was the come right price. By doing this, you get the restated EPS. So remember that EPS will always decline. EPS will always decline, right? So basically, by applying the adjustment fraction, we increase the previously outstanding shares. So if the shares increase, your EPS will fall, right? So that's your restated EPS, right? So in short, what we did, we used this formula coming under the green block. The last year EPS multiplied by theoretical extra price divided by come right price. Now, let's move on to the next question. And remember, if there is a bonus issue in the current year, then also you have to restate the previous year's EPS for comparison purpose. So in that case, again, the adjustment fraction used in case of bonus issue will be taken upside down, right? So the numbers you took in the numerator will be taken in the denominator and vice versa, right? Same in the bonus issue as well. Okay, so now let's move on to the next question, which is 29. So the correct answer over here is 75 point. This is our answer. In cents. Okay, students, let's move on to the next question. This is question number 29 now. So now we are moving on to diluted earnings per share, right? Diluted earnings per share, DEPS. This question is on diluted earnings per share. Now, why do we calculate diluted earnings per share, right? So what happens that sometimes the company has an issue potential ordinary shares, like for example, convertible bonds. Potential ordinary shares are basically those items which will result in an issue of ordinary shares in future. So they are not recently issued, but sometime in future the shares will be issued. So if you have convertible bonds issued now, they may get converted into ordinary shares. As they are converted, there is an option available to the investor that they can convert it into ordinary shares. So convertible bond may get converted into ordinary shares in future, which may result in more ordinary shares in future, and more ordinary shares means more people getting entitled, more shares getting entitled to the earnings of the company. So the EPS will decline. So what happens, using prudence concept, we inform the ordinary shareholders in the very current year only that the EPS may fall if the convertible bond get converted into ordinary shares in the future. So diluted EPS, what do diluted means? Diluted means getting weak. So the earnings per share, the basic earning per share is the strong one, right? The diluted one, in the diluted one, we indicate the users of the financial statements that the current EPS, the basic EPS may get weak if the convertible bonds get converted into ordinary shares. So we have convertible bond as an potential share. Other than the convertible bond, we may have redeemable, preference shares that are convertible, or convertible redeemable preference shares, or we may have share options or warrants. So these are some of the usual potential ordinary shares which may get converted into ordinary shares and increase the company's ordinary shares in the future. But right now they have not resulted in ordinary shares, right? So what is the procedure for this calculation of diluted earnings per share? Two things will happen. See, two things will happen in case of diluted earnings per share. So our EPS formula is the normal EPS formula is the net profit divided by the weighted average ordinary shares, right? So two adjustments we will have to make. What are those two adjustments? We will add the increase in profit, which is known as notional profit. to the numerator. Now what happens that if the convertible bonds get converted into shares, what happens? We won't be paying any interest. Right now, we have deducted the interest expense from the profit. So our profit is lower right now. But once it gets converted in that year, the company won't pay interest expense. So the profits in that year will increase, right? So what we will do, we will take the same assumption that had we not be having the convertible bonds, we won't be having an interest expense. So our profit will increase. So we will add the interest expense currently charged to the profit and loss account over here to the net profit, right? And further, when the convertible bond get converted into shares, the shares will also increase. So we will also add shares in the denominator. So two things happened, one in the numerator and one in the denominator. Okay, so now let's do the working. This is the formula for the diluted earnings per share. Now what happened that the question says that the company's profits are 10.5 million, right? And the liability element is 2.5 million. The liability element of the convertible bond is 2.5 million, on which the company is paying an interest of 8%. So this 8% will be avoided, right, if the bond gets converted. So we will add 28% of 25 million to the net profit. Now one more thing, the interest expense is deducted from the taxable income. Remember, we deduct the interest expense of a company from the taxable income, and the taxable income decline, and we save tax at the rate of 28% in this question. But what happens once there is no interest due to the conversion of bonds? The company won't be able to deduct the interest from the taxable income. Therefore, it won't save tax also on that interest at 28%. So we will be losing that tax benefit. So our income will decline due to increase in our tax expense. So two things will happen. One, our interest expense will decrease, but our tax expense will increase. So two adjustment to the profit will occur. So first, let's do those two adjustments, and then we'll do the share adjustment. Okay, so the profit is 10.5 million, and we will add 8% of 25 lakh, which is the interest expense charged this year, but it won't incur once we convert the bond into ordinary shares. And then the profit will decline due to the tax. So there will be tax on this interest, which we did save this year, but when the bond gets converted, there will be no interest, ultimately more taxable income, and we'll have to pay tax. So what will be the amount of it? So it will be take 8% of the 25 lakh. So 8% of 25 lakh is 200,000. So the taxable income will increase by 200,000, and we will have to pay a tax of 28%. So by this much amount, our profit will decline. So I have deducted it from the net profit, right? So this will be our numerator. Now what about the ordinary shares thing? So about the ordinary shares, currently the weighted average ordinary shares are 6 million, and we will add further shares, the potential shares to it. So now what's the conversion ratio? The conversion ratio is given above, and it is 50 shares. 50 ordinary shares for every $100 convertible bond. So each $100 convertible bond will be converted into 50 shares. So let's assume that these much shares will be issued this year only. So 2.5 million was the convertible bond, divide by 100. So this gives you a number of bonds right now in issue, and multiply this by 50 shares. So this gives you the ordinary shares. So now the next step is $10.5 million profits plus 200,000 interest minus the increase in tax expense by 56,000, which will decrease your profits, right? And then 6 million ordinary shares were already in issue. And further shares will be issued, and that will be equal to 12,50,000, right? So this gives you the EPS, diluted EPS. So divide this, so we will get 146.8 cents. It's $1.46, right? So I have converted it into cents, 146.8 cents. So the correct answer is D. $1.46. So this was about diluted earnings per share. Okay, students, that's the end of EPS. We will be doing some more EPS questions when we do the financial statement, when we prepare the financial statements, because EPS is also asked with the financial statement questions. So we will be doing some more examples over there also, right? So till now, this is enough. We will be doing some more when we will be making the financial statements. Okay, so let's now move on to the next standard, IS 21. I'm giving a minute to you if anyone wants to copy these out, and then I will move on to IS 21. Okay, students, let's move on to IS 21. Okay, so this is a brief summary of IS 21, which we will discuss and we will apply in this section of IS 21. You can see a colorful diagram indicating various rules. Okay, so what do the standards say? The effect of changes in foreign exchange rates. This standard is about, I'm giving you a brief summary, and then we'll start doing questions, right? So what do the standards say? That sometimes a company start doing transactions in foreign currencies, like the companies usually export its products, and they are sometimes selling in foreign currency. So the transaction occurs in foreign currency, but your functional currency and the reporting currency, your currency is suppose rupees, and you are selling in dollars. So the trial balance of yours is being prepared in rupees. So you have to convert the dollar amount of sales, the export sales, into rupees first in order to record sales, right? So this is what required, that you have to convert the foreign currency amount of your transactions, whether it is sales, whether it is purchases, whether it's purchase of goods, whether it's purchase of buildings, whether it's purchase of shares in some external in some foreign countries stock market. So once we do that in foreign currency, we have to convert it into the local currency or the reporting currency. Mainly it's reporting currency in which we prepare our financial statements. So what's the first rule in there? Let's discuss. Please look at the table given in the yellow diagram, the tree diagram in yellow color. So the first block is in green color over there, and green color tells us about the initial recognition of the transaction occurring in foreign currency. So it says that when the transaction occurs, you will have to convert the foreign currency transaction into the reporting currency using the spot rate. Spot rate means the rate prevailing on the date of transaction. So you will convert it at the spot rate. Now what happens in future? Now the future depends on two types of balances. There are two types of balances. One is in purple, the non-monetary account balances, and one is in blue, monetary account balances, right? So if the account balance is a non-monetary account balance. Now, what is a non-monetary account balance? Suppose you buy a building in dollars, and your financial statements are being prepared and issued to the shareholders in rupees. So what you will have to do, you will have to convert the dollar price of the building into rupees first, and you will do it when at the time of acquisition at spot rate. Now after 1 year time, suppose the dollar gets expensive, right? Now what you will do at that time? So first you will think that whether the asset is a monetary asset or a non-monetary asset. The building is a non-monetary asset coming under purple. Now what is a non-monetary asset and what is a monetary asset? It is defined on the right hand side of your screen. If you see the light maroon color block, non-monetary account balance. So what is a non-monetary account balance? From which the benefit or payments in future cannot be accurately measured. So from buildings, property, plant and equipment, intangible assets, we cannot predict the exact amount of payment which will occur in future. But suppose there is a receivable of $100,000. How much cash we will receive in future? It will be exact $100,000. Or if we have to receive an interest of $20,000, so it will be exact. So what happens that these are monetary items. This account receivable, accounts payable, then your foreign currency deposit accounts in the bank. These are all bank overdraft, loan payable, loan receivable, redeemable preference shares, and these are basically redeemable preference shares payable. These are monetary items because you can exactly translate it into cash figures which will occur in future. So monetary, what is monetary items? So monetary balances are those items that will result in receipt or payment of cash in future that can be accurately measured. So you can measure it exactly. So they are monetary accounts. So now as the building is a non-monetary item, we will not retranslate it. So what they say, okay, balance to be reported at the historic values. That is not to be revalued. So if you are using the cost model, this is they are telling that if you are using the cost model, you will not take the effect of the changing foreign currency rate. So what it says, balances shall not be retranslated. You will not retranslate the balances at the reporting date if you are using the cost model. But if you are using the revaluation model, then you will be retranslating. You will have to retranslate it because if the building is in US, then the fair value will be also in US dollars. And when the building gets revalued, the dollar value you will be getting from US. So you will have to convert it into rupees. So in case of revaluation model or using fair value of assets and the fair value change, at that time, what will happen? You will have to retranslate it, right? So ordinarily, if you are using cost model, once you have converted the foreign currency into spot rate, initially you will not revalue it, right? Okay. So now let's move into the monetary items. Now what happens in the monetary items? you have to retranslate always. All monetary items in foreign currency, all monetary balances in foreign currency will have to be retranslated at the reporting date. So you will retranslate it. So in short, you can say if there is a non-monetary item balance, you will not retranslate it on the reporting date. But if it is a monetary item, you will retranslate, right? On the reporting date always. But if you revalue the non-monetary item, then you will have to retranslate. Okay, so that's the brief summary of this standard, and all the rules, important rules have been covered in this diagram. So let's move on to the questions now. Let's do the questions. So students, you will be getting these Excel sheets in a short future. So don't worry, you will be having these rules, so you can refer it afterwards as well when you further revise the topics. Okay, so let's move on to the question number 30. IS 21, the effects of changes in foreign exchange rates, defines the term functional currency. Which of the following is the correct definition of the functional currency? Now, what is a functional currency? There are two types of currencies: reporting currency and functional currency. Reporting currency means the currency in which we prepare the financial statements. So there can be various currencies in which we prepare our financial statements. Suppose I have to present my financial statements to the parent company, right? And they are asking for a particular currency that prepare financials in dollars. So I have to convert from euros to dollars, right? So that's the reporting currency is dollar then. So I have to convert from euro to dollars. Suppose the Asian bank from which I want to borrow, they are asking, or the European bank is asking me for the financials in sterling, pound sterling. So then also I will have to convert my financial statements from, for example, euro into pound sterling. So now the reporting currency is sterling. So reporting currency can be many, but the functional currency will be one. It will only be one. Functional currency means in which the decisions are taken. The currency of the primary economic environment. The functional currency is the currency of the primary economic environment, and in the main environment in which the business operates. That environment's currency, because all decisions will be taken in that currency. So the correct answer to this question number 30 is D. Okay. So the D says the currency of the primary economic environment in which an entity operates. Okay, students, let's move on to the question number 31. So please go through it. So what they say in 31, that Sunshine is an entity with a reporting date of 31st December 2001 and a functional currency of dollars. Now, on 30th June 2001, it purchased land from overseas at a cost of 30 million dinars. Now their own currency is dollars and the foreign currency is foreign currency transaction is of $30 million. Now what have they purchased? They have purchased land. First thing, is it a monetary item or a non-monetary balance? It's a non-monetary item. The benefit from the land cannot be exactly converted into cash terms. So this is a non-monetary item. And secondly, what we have to see regarding non-monetary item, whether we are using the cost model or the revaluation model. So what they are using the cost model. So only one time the dinar figure will get converted into the dollar figure, and that's at inception, at the time of initiation of the transaction. Okay. So 30th June 2001. So what happens that $30 million dinars value is in foreign currency, and the transaction takes place on 30th June 2001. At this date, the rate is 3. So what you will be doing, you will divide $30 million with 3, which is the rate, and this is an indirect quote. Indirect quote means they are telling you the price of the reporting currency, and your reporting currency is dollar. So if they are telling you the price of reporting currency, so in order to convert, you will divide, right? And if they tell you the price of dinar, 1 dinar, then you will multiply. So over here, they are telling you the price of the reporting currency. So you need to divide it. So let's convert first. So our reporting currency value in this case is 30 million divided by 3. And this makes 10. So it makes 10 million. And what they say that what is the carrying amount of the land? At 31st December 2001. So land will not be depreciated, right? And this is not relevant in this case because we are not using the revaluation model. 32 million is not relevant. So the correct answer is A, which is 10 million. This was a very simple question, but you need to have the knowledge to solve it. And so the correct answer is A. Okay, let's move ahead. So the next question is on your screen, the question number 32. So let's do question number 32 now. The entity took out a bank loan for 12 million dinars on 1st of January 2001. It repaid 3 million dinars to the bank on 30th November 2001. The entity has a reporting date of 31st December 2001 and a functional currency of dollars. So their currency is dollars. So now what happens that first check out bank loan, monetary or non-monetary? This 12 million dinars bank loan, monetary or non-monetary? It's a monetary item because you do know exactly how much money to be paid in future. So it's a monetary item. Okay. So let's solve it now. So monetary means you have to keep retranslating it, and the gain or loss occurring on the retranslation will be recognized as an expense in the profit and loss account. So what happened? It was a 12 million loan. I'm taking it in thousands, and there are two pieces of it. One that is paid and one that is outstanding. So two pieces out of it. What they did, they repaid the $3 million amount, and still outstanding is $9 million. Now, when the loan was taken out, at that time 3,000 should be divided on 1st January 2001 by 6. This gives you $500, and then This 9,000 needs to be divided by 6 at the spot rate. So this gives you 1,500. So this is the dollar amount now. Right? So now what happens that at the time of payment, when they repay it, the $3,000, 3,000 dinars were repaid at what rate? So they made a repayment on 30th of November, and at that time the rate was 5. So in dollars, they have made a payment 3,000 divided by 5. This is 600. Right? So they have incurred a loss. They have paid more. Instead of $500, they are paying 600. So loss of 100, and then the remaining amount will be retranslated. So at reporting date, the 9,000 figure will be converted at 5.6 on 31st December 2001. So if we convert it, this makes 1607.143. So we have to give the answer in thousands. So this now results in a loss. The liability has increased. So if the liability increase means you are incurring a loss. So there's the loss of 107. So in total, the losses of, to sum these two, the loss is of 207. So the correct answer is 207 loss. So this is the treatment. So the question asks, what is the total loss arising to the nearest dollars in thousand of the above transaction in the year ended 31st December 2001? So it's 207,000. So you have to give it in thousand. It's 207, right? So students, you can copy this answer, and I'll be giving you a minute for it. And I'm muting my voice for a minute, and then I will restart, right? Okay, students, I hope you have completed this one. Now the next question is 33. Let's do question number 33. So it says, a manufacturing entity buys a machine, an item of property, plant, equipment for 20 million dinars. So they have purchased the machine at 20 million dinars. And this is on 1st of January 2001. Now what they say, the machine is held under the cost model. So it's cost model again, and has a useful life of 20 years, right? So the entity has a reporting date of 31st December 2001. This is after 1 year's time of purchasing it, and a functional currency of dollars. So you have to convert dinars into dollars, and the price of dollar is given again. And this is the functional currency or the reporting currency. So what is the carrying amount of the machine at 31st December 2001? So initially they will recognize at spot rate and then reduce the and then deduct the depreciation to arrive at the carrying value. So this will give you the cost of property, plant and equipment. This will be 20 million dinars divided by the 1st January rate, which is 2. Divided, you get $10 million. Then you will calculate depreciation. So depreciation is 10 divided by 20 years. So this makes this gives you the carrying value of 9.5 million. The correct answer is $9.5 million. It's C. Okay, students. So let's move on to the next standard now. That's the end of IS 21. We will be doing a bit of IS 21 in probably the financial statement question as well. Okay. So moving on to IS 8. It is accounting policies, changes in accounting estimates and errors. So student will be having a break at 6:50 around, and it will be 15-minute long break. But let's start first IS 8. We have 2 minutes to go, and then we'll have the break. So students, let's start with IS 8. IS 8 covers 3 things. I'm giving a briefing about IS 8 first. It covers 3 things, which you can see over here in light maroon, green and purple, right? In light maroon, you will be seeing accounting for a change in accounting estimates. If an estimate change, it will be applied prospectively. Prospectively means from the date when the change takes place. Nothing to do with previous year's profits or retained earnings. Nothing to do with it. It will be applied in the current year. If the change occurs right now in the current year, if you notice it today or in the current year, you will apply it from the current year and onwards. And then accounting for prior period errors. Prior period error means that error occurred in the past and you did not detect it. You detected it in the current year. So now what happens? You cannot correct in the current year. You will be corrected in the latest the financial that will be published, but you will be adjusting the opening retained earnings. You cannot adjust the current year's profits for it because the error occurred in previous year. So you have to correct the profits also of the previous year. And if you adjust the profit of the previous year, your opening retained earnings will change. So it's a retrospective adjustment. And also the assets or liability, the corresponding effect will be also taken to the opening balance of the asset or liability. So your profit will be adjusted for the previous year, for the comparative year, or even earlier if it is, and the opening balances of the asset or liability, but not current year profit should not be adjusted for. The same way, if an accounting policy is changed. Now, if accounting policy change, there are 2 rules that why did the accounting policy change, and so accordingly we will talk about it in the upcoming questions. So let me tell you, if accounting policy has to be changed mandatorily. Mandatorily means a new standard arrives and that standard tells you that to use this accounting policy, and earlier you were using some other policy. So what happens that if you change the policy due to the arrival of the new standard or the new rule in the IFRS. You must follow it, and you will. How will you follow it? How will you apply it? So it will be according to the rules given in the standard. As the standard says, you will be using that rule. So whatever the standard says. In one of the standards, like in borrowing costs, that once a change occurred, so what they said that apply it prospectively. So even it was a change in policy, we had to apply it prospectively. It depends now on the standard, and that principle that tells you about how to apply the new policy in the accounting standard is known as transition rule. It is known as transition rule. So when is the transition rule used? It is used when the change is required by an IFRS, right? And if the change is voluntary, voluntary means the company believes that the revised accounting policy will be presenting reliable financial statements, will reflect fairness. So that will be a voluntary change. So only there are two reasons for change in policy. You would have earlier studied in past that the policy application should be consistent. It should not change again and again, isn't it? So it should not change in reality. But sometimes you need to change the policy because it results in fairness or it is required by IFRS. So if IFRS required, use the transition rule. And if you are changing voluntary, that will result in fair presentation. Only then you can change it. No other reasons. Only fair presentation is a reason. You cannot manipulate the financial statements for other reasons. So in case of voluntary, you will be applying it retrospectively. Means retrospective application means that the old policy was never there. You will apply the new policy in the way that older policy was never there. That the new policy which is now going to be applied was always applicable. In that manner we will apply. Means we have to adjust the previous year's financial statements as well. That's why it's known as retrospective policy. Okay, students, so let's have a break, and then we will start in around 15 minutes time. So please continue with the break. See you after break. I'm muting my voice. So until then, my voice will be muted. Welcome back, students. I hope you would have offered your prayers and enjoyed your break. So let's continue again. So let's start with the questions on IAS 8 now. So please read the first question now, students. Please read the first question. This is question number 34 on IAS 8. So students, please read the question and suggest an answer. I'll be giving you the answer in a minute time. So it is according to the above rules only. Okay, students, the correct answer to this question question number 34 is C. So as I said earlier, that the prior period errors will have to be corrected in prior years. We have to restate the previous year's amounts, and then along with it, you have to give a disclosure as well. Because once you restate the financial statement, people will compare the financial statement financial statements compared to figures with last year's financial statements, and that won't match. So you have to give a disclosure to explain that why they have changed the amount, and you have to show them that what the error was and what was the financial effect of the error, and that the error is corrected. So three things you have to tell in the disclosure, that what was the error and what was the financial effect, means the effect on the profits and on the assets, liabilities, etc. And has the error been corrected or not? Obviously you would have corrected the error, so you will write that the managements have been adjusted to reflect fairness. Okay, now question number 35. Just in a half minute, please attempt it. I'll give you the answer in half a minute. So correct answer is A and D. You can only change the policy when it is required by an IFRS, or it results in more reliable or fair presentation. Otherwise, you cannot change. So B and C are not possible. Okay, question 36. So half minute to do it. Please suggest your answer, then I'll do it. So students, changing a rule, changing a rule to account for a transaction is an accounting policy. So over here, what they say, they are changing the commission earned from revenue to other operating income. Or sorry, from other operating income to revenue. So that's change in accounting policy. They have changed the rule, right? And changing a number itself, changing a number, suppose from 8% to 10%, we are changing the estimate, the 8% to 10%, or reducing it, or we are changing a life from 10 years to 12 years, or from reducing it from 10 years to 6 years. This is changing a number. Or we are changing a pattern of consumption, like from straight line to reducing balance like. So this is something change in estimate, if you are changing a consumption pattern or changing a number. So changing the useful life of depreciable asset is not a change in accounting policy. It is a change in accounting estimate, because we are changing number, which is the estimate itself. So revising the remaining useful life is change in accounting estimate. So remember a few examples of change in accounting estimate, that if the percentage of depreciation amortization changes, the percentage of bad debt changes, or the bad debt is recovered, right? Or there is a change in the depreciation method or the amortization method, which reflects pattern of consumption. So these are all change in accounting estimates. Okay, next question number 37. Okay, please go through it. I'll be doing it in a minute's time. You can just realize the impacts in your mind, and then I'll be doing it. Okay, students, look, the lease is for 4 years, and what they have done, they have recorded the payment of 210,000 as an expense. So if the lease is for 4 years, it's a long-term lease. You cannot record payment as an expense in case of lease. You have to record right of use as an asset and a liability. You have to debit the asset and a liability, and then you have to depreciate that asset. So the accounting treatment has gone wrong. They have recorded the payment as an expense. So this should not be recognized as an expense. So the expense will be credited, which was previously debited. So what happens, that we will reduce the expense first. And we have to do the retrospective adjustment. In 2004, we have to adjust the opening retained earnings. So we will credit the opening retained earnings by 210,000 in order to increase the profits by this much amount. So we will reduce the expense by 210,000 and our profits will increase. What next? We will debit the retained earnings. To record depreciation expense. As the lease requires to recognize an asset, then you'll have to depreciate that asset. So the depreciation expense will be 635,000 divided by the lease term. So the lease term is 4 years. So we'll take a debit. Okay, so we will divide by 5 years, students. Why 5 years? Let me tell you the rule. Divide by 5 years. So 635,000 divide by 5. This makes 127,000. Why 5 years? See, the lease asset, the depreciation of lease asset. Lease asset shall be depreciated over how many years? It depends that whether the title of the asset transferred to the lessee by the end of lease term or not. Please note this rule because this rule will also be covered in IFRS 16. So if the title transfer to the lessee by the end of lease term, then you will record depreciation over assets useful life, because the title will transfer to the lessee and the lessee will be able to use the asset for all of its life. Okay. And then if the title transfer is not certain, so in this case the title will transfer. So if the title transfer is not certain, what happens then? How many years? So if title do not transfer, you will divide the right of use over lower of the assets useful life and lease term. We'll divide over lower of useful life and assets lease term. What happens here in this question? In this question, this has happened. Title transfer to the lessee. Look what the question says. According to the question, the asset has a useful life of 5 years and the lease term is for 4 years. Now what to do? The important thing was that the legal ownership will pass to Badger. So as the legal ownership passed to the Badger, then this rule gets applicable, that over the useful life. So I've used this one, right? So please note this rule because in a time we will be doing IFRS 16 leases. So this rule will be discussed over there as well again in a question, right? So let's move on to the next point now. So what happens that depreciation is recognized. This will be a debit to the retained earnings because due to the recognition of depreciation in the previous year, the expense will increase and the profits will go down. And then financial charges. So IFRS 16 requires that you will record an asset and a liability when you enter into a long-term lease agreement. So on the asset, you have recognized the depreciation. On the liability of 635,000, you will be recording a financial charge, 6,35,000. You have not paid anything. You did the balance was 635,000 during the previous year, 2004. So if the balance is 635,000, you will be paying an interest of 12.2% on it. This makes 12.2% 77,470. So total debit in the previous year will be 127,000 and 44 for 77,470. And the credit will be of 210,000. Therefore, the credit exceeds the debit. By how much? Deduct 204,470 from 210,000. So 5530. So this is the correct answer. So over here, you had to be very smart. You have to be very careful that what items will be affected and what they tell in the question. So they said that they recognize 210,000, the payment itself as an expense. Whereas what the standard says to record depreciation expense and financial charges. So now what we do, that we will remove the 210,000 expense from the profit and loss account in the previous year. So that will increase the profit by 210,000, and we will reduce the profit by the depreciation expense and the financial charges, which sums up to 204,470. The correct answer is will increase the profit by 5,530. So it's A. So this was a retrospective adjustment. Opening retained earnings were adjusted. Okay, students. So you can complete it. I'm giving you a minute's time to complete it if you are noting it somewhere. So please do it, and then come on to question number 38, which is the last question for IS 8 over here. Okay, students. What about question 38? I told you about this depreciation method a few minutes ago. Depreciation method, the change in policy or change in estimate. What is it? It's a change in accounting estimate and must be applied prospectively. All change in accounting estimates are applied prospectively. The current answer is D. So depreciation method and amortization method looks like that it's a rule, but it's not a rule. It's a consumption pattern. Like straight line indicates equal consumption every year. So it's an estimate that the asset will be consumed equally, and reducing balance method indicates that more consumption in earlier years, less in the later. So that also is basically a pattern. The pattern of consumption is an estimate. So if you are determining that what amount has been spent, so it's an estimate. It's not. So this is not a rule. This is basically the portion of the asset that has been consumed. The portion is always an estimate. Okay, students. So let's move on. Let me write down the answer first. The correct answer is okay. So students, let's move on to IFRS 5 now. Next one is IFRS 5. Students, in IFRS 5, uh, the IFRS 5 covers those assets which have been decided to be sold in the upcoming year, in the next year, or uh, after the end of the reporting period in a very short time interval. So if they have been, if we have decided that they are to be sold in the near future, so what needs to be done? We will stop recording depreciation on it because it is no more a non-current asset for us, as we have already decided that we are not going to use it anymore, or we are going to sell it. So we will not charge depreciation on it. Secondly, we will not show it a non-current asset because it is not a non-current asset anymore. So it should be transferred to a current asset item. And third, we have to see whether any loss is expected of it. If any loss is expected of it, we should charge that loss immediately on it in the profit and loss account. So that's important. Like in inventory, it is available for sale. So we compare the carrying the cost and NRV of the inventory, and we record it at the lower amount, lower of cost NRV. Over here, we recognize it lower of carrying value and fair value less cost to sell. So a similar rule like inventory is applied over here, lower of carrying value, fair value less cost to sell. Now, question 39 is based on this rule. So please go through it. What it says BN has an asset that was classified as held for sale. So as it is classified as held for sale, we have to look at its carrying value. So its carrying value is 900,000 and its fair value is 800,000, which will appear in blue before you, in blue shading. So fair value is 800, and fair value will, if you sell it, you have to incur some cost of disposal, like you have to pay the commission to the agent in order to facilitate you in selling the asset. So what happens that you will receive 800 by selling it, but you have to also pay $50 commission. So 750 will be the receipts in net. So what the standard says over here, that a loss is expected in this question. The standard says that the asset will be carried at, right now the carrying value is $900, but after the decision it will be carried at lower of carrying value and fair value less cost to sell. So the fair value less cost to sell is lower in this case. 800 minus 50, this makes 750. So you have to reduce the asset and you have to bring it down to 750. So if you bring the asset down to 750, means the asset will be credited and the profit and loss account will be debited. So if you reduce from 900 to 750, right? So the correct answer is, which value should be used for the asset at 31st March 2002? Correct answer is A. 750 is the correct answer. And 150 will be charged to the profit and loss account. Okay, move on to the next item. question number 40. So as per question 40, it says that it talks about discontinued operation. Discontinued operation is a group of asset which generates cash independently, like a cash generating unit or a subsidiary company, right? So it's all about a complete group which is uh, generating revenue for the company. So if you decide to discontinue a complete operation, a line of business, what happens then? So what happens that if you discontinue line of business, you will uh, report the revenues and expenses, uh, details of the revenues and expenses separately in a note to the financial statement. And on the face of the income statement, you will show the profit from the continuing operations and the profit from the continuing discontinuing operations separately. So on the face of the income statement, there is a disclosure requirement that you will be showing the revenues, expenses, and all necessary details of the continuing operations only, right? So revenues, expenses, and all details of continued operation only on the face of the income statement. And then you will add the profits or loss of the discontinued operation to the details of the continuing operations to arrive at the net profit for the year, right? But the details of revenues and expenses of discontinued operation will not appear on the face. They will appear in a note to the financial statement, and they should not be mixed with the continuing operations once you have decided that the operation is a discontinuing operation. So what happens that they are asking over here, okay, should you uh, show the revenue and gross profit separately? No, no details. Just profit after tax will be shown on the face of the profit and loss account, and the remaining details and the analysis will be showed in the note to the financial statement. So the answer to this question is, for a discontinuing operation where the decision has been taken and the constructive obligation is present, you will not show on the face the revenues and the gross profit, but you will show the net profit of the discontinuing operations on the face, right? So this is the correct answer. So let's move on to question number 41 now. This was a disclosure requirement. So about 41, please go through it. What should be the carrying amount of the property? So again, the same rule will be applied. First April, the carrying amount was 800,000. Estimated life of 16 years. It was carried under cost model. On 1st October 2004, 1st October 2004, Tilly decided to sell the property. Means now it is held for sale. So a property agent reported that the property's fair value on 1st October 2004 is 790,500, which had not changed since change at 31st March 2005. Now you will stop depreciating the asset when you decide on 1st of October. So on 1st of October, we have decided that we are going to sell the property. So what you need to do first is calculate the carrying value first. So the carrying value 800,000 is given on 1st of April. So you need to charge further depreciation 800,000 divided by remaining life, which is 16 years, multiplied by 6 divided by 12. So 6 months depreciation needs to be charged. So this gives you the carrying value of 7,75,000 after charging depreciation. This is on 1st of October 20x4. This is the time since when you will stop charging the depreciation, right? Because you have classified it as held for sale. Now, what is fair value less cost to sell? Fair value less cost to sell is 7,90,500. So, at what amount we will report? You will report at lower of both. The lower amount is 7,75,000. So, the correct answer is A, 7,75,000. So over here, why carrying value is lower? Because gain is expected. Gain will not be recognized in advance. Expected gains you cannot recognize in advance, but expected losses shall be recognized immediately. So over here, you will be selling at more than the carrying amount. Therefore, we are not recognizing the gain. So that's all IFRS 5. And now we move on to IFRS 16. Okay, students. So there we go. We move on to IFRS 16, accounting for leases. So in accounting for leases, let me give you a brief. We'll be talking about simple leases and we'll be talking about sale and leaseback transactions. So first, let's talk about the leases. What do the accounting standard tell about leases is you have to record an asset plus a liability related to a long-term lease. When the duration of the lease, the time interval of the lease is more than 1 year. If the time interval is less than 1 year or 1 year, you can directly charge the payment as an expense. So you don't need to recognize an asset or a liability, asset and a liability in case the lease is of a short term or very immaterial, a very small amount. So in this case, if you see, this is a lease for 5 years. So please go through the question. I'll show you the treatment for question 1. So what happened that they say during the year ended 30th September 2004, Hyper entered into 2 lease agreements. Be careful. They are telling you about 2 lease agreements. On 1 October 2003, Hyper made a payment of 90,000, being the first of the 5 equal installments under a lease for an item of plant. This is of plant. The lease has an implicit rate of 10%. The interest rate was 10%, and the present value of the total payment was 340. Right? So what are they asking about? What amount in total would be charged to the statement of profit and loss? So as discussed in that correction of error question in IS 8, you have to charge depreciation expense and financial charge. So let's first calculate depreciation expense and financial charge. The depreciation expense over here will be recognized over 5 years. So they haven't told you anything about useful life or the title transfer. So simply you have to charge depreciation over the lease term over here. So 3,40,000 is the present value at which you will be recognizing the asset. So present value is 340,000. At this amount, you will be recognizing the asset, present value of the lease payments, and divided by 5 years to calculate the depreciation. So this gives you 3,40,000 divided by 5, 68,000 is the expense. Then you have to calculate the financial charges. Now, the present value amount was 3,40,000. right? They immediately paid on 1st of October 2003. They immediately paid 90,000 out of it. So paying 90,000 will reduce the liability balance. So the present value reflects the principal amount of the liability, and they have paid 90,000 out of it. So the balance now remaining outstanding at the beginning of the year was 250,000. So you are going to apply 10% of it on it. 10% will be applied to 250,000. This gives you a finance charge of 25,000. This is what required in case of lease to the profit and loss account. These two expenses will be recognized: depreciation expense and financial charges. What else? This is for the first lease. What about the second lease? In case of second lease, on 1 January 2004, this lease has been signed on 1st January 2004. So from this date till 30th September, this makes 9 months. They made a payment of 18,000, and this lease is just for 1 year's time. 1 year time, this is a short-term lease. In this case, you won't be recognizing right of use and liability. You will directly charge rent expense in the profit and loss account, but not for a year, for 9 months, because the expense depends on the services you have taken. So you have just taken services of 9 months in this year. So you will recognize expense for 9 months. For the second lease, so 18,000 multiplied by 9 divided by 12, this gives you an expense 13,500, and sum of all these items students, I would suggest that you people also keep calculating on your equipments, and if you want, it's better that you keep writing as well, so you can take more interest in the subject. So and you can remember things well. 106,500 is the correct answer. The correct answer is this is option C. Okay, let's move on to the second question. So over here, Z entered into a 5-year lease agreement on 1 November 2002, paying 10,975 per annum, commencing on 31st October 2003. So the first payment is after 1 year's time. The lease starts on 1st November 2002, but the payment will occur in 1 year's time. The present value of the lease payment was 45,000, and the interest rate implicit in the lease was 7%. Now, what they are asking? They are asking about the non-current liabilities. Non-current liabilities means amount payable after 12 months of this date. Current liability means payable within 12 months of 31st October 2030. But we want the amount payable after 12 months of this date. So let's calculate the amount that will be paid after 12 months of the reporting date. So let's make a working. lease was signed on 1st of November 20x2, and on that date the balance was 45,000, right? The balance column shows the principal amount, right? The 1st November 2002 was this much. Now what happens that the interest will be calculated on 45,000 amount. On 45,000 you will calculate the interest because no payment occurs on 1st November 2002. The payment will occur after 1 year's time. So this much of the amount, 45,000 balance, was outstanding. So we will be calculating 7% on this amount. So this makes 3150. Now 31st December arrives. 20x3. On this date you make a payment of 10975. When you make this payment, so along with this payment you pay the interest. So what you do is, out of 10,975 deduct the interest amount 3150. So it gives you 7825. So this 7825 amount has been the principal repayment. So the liability decreases from 45,000 to the new amount, the new balance, which is 37175. Now 37175 is the balance to be reported in the financial statements, right? But we want the non-current portion. Within the next 12 months, on 31st December 2004, we will be making another payment. So the principal out of that payment, the next payment which occurs in 12 months, is a current liability. So first remove that current liability. So 10975 includes interest as well, which will be taken on 37,175. 37,175 is the balance, multiplied by 7% makes 2602.25. Let's round it off, 2602. So the principal repayment is 10,975 minus the interest 260. This gives you 8373. By paying this much amount, this is the current liability. This amount is going to be paid. This 8373 is going to be paid in 12 months time. So we'll exclude this amount. If you exclude this amount from your total liability of 37,175, you arrive at the non-current liability. Right? So deduct it. So it makes 28,802. So the correct answer is B, 28,802. So remember, the lease liability at the end of the reporting period shall be classified properly. Otherwise, your current ratios will go wrong. Your gearing ratio will get incorrect, right? So what you need to do, you need to see that what principal amount is payable within 12 months and what after 12 months. Interest has not yet gone due because you have made the payment after 12 months time. So you have paid the interest which have got due for this year plus the principal amount for the current year. But next year principal only will be shown as a liability. Interest will not be shown because recording interest depends on the passage of time. As the time passes on, you will keep recognizing the interest, right? So that's why I'm excluding the interest from 10,975, the upcoming interest. Okay, let's move on to the next question. Question number 3. Now three things have been asked. Let's check the date first. What date do they ask? they're asking on 31st December 2004, and the lease has been signed on 1st January 2003. Means they are talking about the end of the second year. Lease has been signed in 2003. These people are talking about the second year. So let's make the same schedule which I drew earlier, the lease amortization schedule. Okay. In this question, question number 3, please note that what's the present value? The present value is 86,240, excluding the initial payment. So they've already deducted the initial payment of 13,760 out of it. And then there are further 5 annual payments of 20,000, which get due on 1st January 2003. So the payments are all in advance. In the earlier question, the payments were in arrears. In this question, the payments are in advance. Right? So let's make that amortization schedule. All of these figures which are required will be found from the lease amortization schedule. Okay. So the lease was signed on 1st of January X3, and the present value was 86,240. Immediately they made a payment, and the payment amount was 20,000, which they paid. Now, if they pay immediately, there won't be any interest in it, right? The interest is the cost of time. So once the time elapses, it passes on, then only the interest will be recognized. So the first payment did not include any interest payments. So I deduct 20,000 from it. Now the balance left behind after this 20,000 payment of principal is 86,240 minus 20,000. This gives you 66,240. Now the next year, the interest, the 2003's interest, the interest to be recognized on 66,240, right? So the interest rate as per question is 8%. So let's round it off. So this is the interest for the year 2003, because the balance during 2003 was 66,240, right? Then on 1st January X4, another payment occurs. So when this payment occurs, interest will be paid off in this payment, and the principal amount will be 20,000 minus 5299. So if we deduct this amount from the principal amount, the amount left behind 66,240 minus 14,701. So this is the balance to be reported by the end of 31st December 2004, 51,539. Now we need to know the current portion. So what will be the current portion? The amount which is payable in 12 months time, and the rest will be non-current portion. If we deduct the current portion, we get the non-current portion. So on 31st December 2004, you will see that on 1st January 2005, which is within a day, you are paying 20,000 more, and that 20,000 will be including an interest of 8% on 51,539, which is 4123. This interest is for the year 2004. So if we see what principal amount is being paid, 20,000 minus 4123. This is the principal amount. So the rest amount, the non-current liability. So what is the answer? The answer is the one you can see in blue. Right? Now see, you are now due to pay 41,223 interest payment for the year 2004. This interest is due for the year 2004, and plus this amount is payable within the next 12 months, the principal amount. This is in 12 months time, right? This amount is non-current. So total amount of current liability is 20,000. The interest which has got due for 2004, sum of these two, the interest due and 15877. So the financial charge for the 2004 is this much. This 5299 is for the first year, 20x3. They are asking about 2004. So this is the correct one. Then 35,662, this is the correct, and the current liability is 20,000. So the correct answer is A. Okay. So students, now next question, question number 4. If you have got tired, I can give you a 5-minute break, and then we start with the sale and leaseback transaction, because now this question is on sale and leaseback. This is an important one. So if you want to get a bit fresh, I can give you a 5-minute break. See what they say. Sideshow sold a property. So first it sold the property, and then it obtained it back on lease under a 5-year lease. But please note that what was the life of the property? What was the remaining life of the property? Remaining life of the property was 20 years, out of which the lease was only for 5 years. So before I go on to this question number 4, the sale and leaseback transaction, let's have a short break of 5 to 10 minutes. So I'm muting my voice for 5 to 10 minutes, 5 minutes, I think. I will be back at 8:50. In 10 minutes, I'll be back, right? So please take a break, and then we'll start again, right? So see you, and you will listen to me in 10 minutes time. Students, you can continue the break. You have 2 or 3 more minutes. I'm just writing it down to speed up the things. Okay, students, 10 minutes are over. Let's begin. So, students, you can see these 3 colors over here on the right hand side of the screen. And what happens that the slideshow has sold the property for 2 million. So they are asking for the entries, right? So what shall be the entry? First of all, they receive cash, which is 2 million, the sale proceeds. Second, they retain a portion of the asset. What they do, they have retained a portion, like in, you can read in the red, if the seller retains a portion of asset, which he does. So he has sold the asset, but he will be using the asset for further 5 years. So he retains a portion of the asset, but not all, right? So the life is 20 years, but he'll be using for 5 years. So what happens that he has to show some carrying value of the property, plant, equipment still in the financial statements. Now, how much? The property, plant, equipment carrying value to appear in financial statements will be as follows. How will you determine the portion that will appear? Because he is going to use for 5 years. The portion will be like this. The existing carrying value which is, according to the question, the existing carrying value is 1.6 million. This is what right now present in the financial statements. So this will be multiplied by the present value of lease payments. So this is the way how we determine that what portion has been retained. So the amount of cash he's going to give today, he's going to give more, but we'll take the present value because excluding interest, how much he's giving, we'll take that one and divide it with the fair value. So in this way, we come to know that what portion he has retained. Do not divide the live elements. Huh? You have to use this formula only. That how much he's going to pay. So what he's going to pay is the present value of rental 599,000. This is excluding interest, and the fair value is 2 million. So what do this mean? If he's paying only 599,000 out of 2 million, means he has retained this much of the portion. So the portion, this is the retained portion of the carrying value, which makes 4,79,200. So this needs to be debited 479,200. This will remain in the books, right? And this is the right of use, like the same in the lease. Like if you lease an asset, you record asset. So this is the asset, right? Then you need to credit the asset itself, which is at 16 lakh. So we remove the asset from 16 lakh and bring it in at 4,79,200. What next? In case of lease, you record a lease obligation, a lease liability. We record an asset and a lease liability. So lease liability will be recognized at same amount, the present value. So what is the present value here? 599,000, right? And in the end, you earn a gain. Now, what gain you have earned in this case? So the gain earned will be the portion of the asset surrendered. When you can record a gain? You can only record a gain when you sell something, right? So you have not sold the whole of the asset. You have retained a portion of it. So the retained portion is this much. See, what is the retained portion? If you divide this 599,000 with 2 million, right? You get 29.95%. So this much you have retained. So the rest has been sold. So what portion is sold? 70.05%. So you can only record the portion of the gain which has been sold, the portion which has been sold. So how we will calculate that gain? So this is like this. The total gain is on the asset is 4 lakh. Am I right? 4 lakh? 4 lakh comes like this. 2 million was the sales price minus the carrying value, which was 16 lakh. This gives you 400,000 or 0.4 million, right? This is the gain. Now, out of this, what has been retained? Check that what portion is retained. So the retained portion is 1 minus 599,000 divided by 2 million. So I've deducted 29.95 from the 100%. So if you deduct 29.95 from the 100% amount, you will get the gain that will be recognized. So what's the gain that will be recognized over here is 4 lakh multiplied by 0.7005 means 70.5%, the portion that is surrendered. So this amounts to 4 lakh multiplied by 0.7005. This is 280,200. So the gain recognized will be 280,200. Now you can check that the entry is balanced. You can take the gain as a balancing figure as well. This can be a balancing figure as well. Automatically it would come to 288,200. So this is the entry. For the sale and lease back transaction, where a portion has been retained and the remaining is sold. So let me give the formula. The carrying value to be retained and the gain to be reported. The formula is like that. You will take the existing carrying value. I've given you the formula for this carrying value to be retained. This is existing carrying value multiplied by present value of lease payment divided by fair value. What will be the portion of gain that will be recognized? You will take the full gain, and multiply it by 1 minus this portion, the retained portion. So you get the portion that is surrendered. So if you sell an asset, the portion that is surrendered, only the gain to that much extent you can recognize. So these are the formula which you need to remember. The portion of carrying value and the portion of gain to be reported. So what I have done, I've used this formula to calculate the gain and this formula to calculate the carrying value, right? Which you can see over here on the right hand side. And then other things are obvious. Lease liabilities 599,000. The asset being removed from the books will be at 16 lakh, right? And 20 lakh was the 2 million was the cash to be collected. The most important things are these one: the property to be carried and the gain to be recognized. Now what happens? What's given in the question? See, what else is required? Depreciation. They have calculated the depreciation. So calculate the depreciation. So depreciation is equal to 479,200 divided by the life, which is 5 years. This gives you a depreciation of 479,200 divided by 5. This gives you a depreciation of 95,840, and further they are calculating a finance charge after the sale and lease back. So what was the liability? The liability was 5,99,000, and this remained until 1 year's time, and the interest rate on it is 8%. So calculate 8% on 5,99,000. This gives you 47,920. So the depreciation charge, the finance charge. I'm highlighting the answer in red, right? And the gain, which was recorded, 280,000, right? So these three items are given in this first option. The correct answer is A. Profit on disposal 280,200, depreciation 95,840, and finance cost 47,920. This is the correct answer. This question was a bit longer. You won't be asked this much longer question for 2 mark, obviously, but this question involved most of the accounting for sale and leaseback transaction when you retain some portion of the asset. That's why I took this question, so that I can cover most of the portion of the sale and leaseback concepts over here, right? So this is it for the sale and leaseback transaction where you retain a portion of it. Now, suppose if you retain all of it, suppose you sell the asset and retain all of the portion of the asset, then what? So that we need to know, that if we retain 100% of the portion. So that's coming up in the next question. So let's move to the next question now. I'm waiting for a minute so that if you need to copy or put it down, you can do it. Okay, students, let's move on to question number 5. Now see what happens here. What's the difference, main difference? In this question, the asset has the remaining life of 10 years. And then lease it back. First, he sold it and lease it back for 10 years. So leasing it back for 10 years means he has not transferred any benefit to the buyer. If he has not transferred any benefit to the buyer, why is he receiving cash? So if he is receiving cash without giving any benefit to the buyer, then it's a loan. So in this case, what is the substance? The substance in this case is substance of the transaction. In this case, is that the seller, lessee, he was initially a seller and then he became lessee, has retained all of the asset. Therefore, asset will remain in its books as normal, as we account for it normally, and the cash received will be accounted for as a loan and interest will be calculated on it. So this is the substance of this transaction. So how did we identify that all of the asset is controlled? The lease back is equal to 10 years, which is the assets remaining life. Okay, so what they asked for is what is the total expense that should be recognized in the profit and loss account. So if we will account for normally, we'll record a loan, so we will charge an interest on loan. The entry will be like this. The entry on sale and leaseback will be debit bank account, and the debit is by the cash received amount, 7 million. This is in thousands, and we will credit the loan account by 7 million. So that's the entry on the sale and leaseback, where all of the asset has been retained, right? And the next entry will be what happens. We will record depreciation expense on the asset, and we will record the financial charges. So the depreciation expense that will be recognized on this asset will be on the book value of the asset. So the book value of the asset is 6 million according to the question. So it will be recognized on 6 million divided by 10 years. And the interest will be recognized on the 7 million loan at the interest rate, which is 7%. So $6 million divided by 10 years life, this gives you the depreciation expense, and the finance charge will be calculated on the loan amount, 7 million multiplied by 7%. So one of the amount that will be recognized on the asset depreciation expense will go to the profit and loss, and the second amount that will go to profit and loss will be financial charge against this lease. So this is in thousands, and the total amount is so students, is it clear that if you retain a portion, you will be using the same treatment which was shown in question number 4, and if you retain all of the asset, then you will be recognizing as a loan, and you'll record the depreciation as usual on that asset, and will record the financial charges. So 1090 is the total expense. So the answer is in terms of thousand, this is 1090. Otherwise, it is 1,090,000. Okay. So this is the second type of sale and leaseback transaction. Okay. Now let's take this case scenario relates to question 6 to 10. This is a revision on the lease which we have discussed till now, and then we move on to IFRS 15. So if you like, I can give you this question 6 to 10 as an assignment as well. So let me give you as an assignment. So can you do it for tomorrow? So do this 6 to 10 for tomorrow, and I will discuss the answers to this question tomorrow, right? Or let me give you answers. You can just try to reach those answers, right? So the answer to the question number 6 is dollar. If you follow the rules given above, you will be able to do it. The answer to question number 6 is 75,780. You can note them. Then question 7. The answer is B. If you don't, if you are not able to answer this question, you can't reach the correct answer, you can ask me on the WhatsApp group as well, right? So you're welcome to the WhatsApp group to ask any answers if you do not match, if it doesn't match with these. So the answer to question 7 is B. Then question number 8. Will be C. question number 9. Correct answer is B. And question number 10. Let's do question number 10 at least. Statement 1. Let's do question number 10. Statement 1, it says in a sale and leaseback transaction, no profit will be recognized by the lessee. No, that's not correct. Sale and leaseback, you could recognize profit if a portion is retained. So that's not correct. It's not always. This is false. Then, secondly, it says, the second statement, that in a sale and leaseback transaction, the sale proceeds will usually be treated as a loan. It's not always, it's not usually treated as a loan. Sometimes the sale proceeds is not treated as a loan. Sometimes it is a sale, like in question number 4. But in question 5, the whole proceeds were loan. So this is also false. It's not usual. In many cases, it's not a loan when some of the portion is retained, right? So both of these are false. Okay, students. So that's end of the leases portion. Now move on to IFRS 15. So revenue from contracts with customers. So students, let's start with revenue from contract with customers. Okay. Now I'm not moving in the sequence. I'm starting with a case study first, and then we will come back to the question number 12, right? So please, if you come on to question number 16 first. We'll do question number 16 first. So I'm moving on to question 16 first. We'll come back to 12. Okay. So we're going to do question number 16 first. So please read this question out. Question number 16, revenue from contract with customers. Let me give you an important point regarding revenue from contract with customers. See, when someone receives money, it doesn't mean that the money received becomes revenue. The money received is usually liability because you have to do something against it. So if you receive money, but you have to perform some obligation against receiving that money, to until and unless you perform that obligation, or to provide, or until and unless you give the goods or the services against the receiving of those money, till then you cannot recognize the revenue. So you have to wait until you have settled the obligation. So once you settle your obligation, you have performed your obligation, only then you can recognize the revenue. Now what happens that in case of sale of goods in retail market, you go to the shopkeeper, you take the goods immediately and pay the money. So this was a simple case. But suppose that the seller takes 2 years to make those goods. What then? So will he be waiting for 2 years to recognize revenue? No, he won't. What IFRS 15 says that according to the progress of work, if 20% of work is completed in the current year, you can recognize 20% revenue. But obviously, the seller should be able to decide that he knows the outcome and he knows that he will be successful in performing the obligation and he will be able to discharge his obligation as per the agreement. So only then he can use the progress method. So now what happens over here, that they've asked you for the revenues. In this question 16, let me mark the important areas. How much revenue and cost of sales? This is required. On what date? 31st October 2005. So they have entered into the contract on 1st November, and after 12 months, this revenue and expense cost of sales is required. And this contract will continue for 2 years. So one year has gone. This is end of 1 year. Now what happens? The sales value of the full contract is 40 million. You can't recognize full revenue, 40 million. You have to recognize some portion. How much? According to the progress. So what portion has been worked till now? What obligation has been discharged till now? It is 45%. So what happens? You will recognize 40% of the revenue and 40% of the cost. So by doing this, the profit recognized will also be 45%. So what IFRS 15 says that the amount of profits that will be recognized, the amount of revenues that will be recognized will be equal to the progress of the work. So now we will follow this rule, the progress of the work, which is 45%. The sales value is 40 million. So we will take 45% of the 40 million amount. So one of the things is we'll take 45% of 40 million. Now what about the cost of goods sold? This is the amount of revenue. So the cost of goods sold working, I'm using a different color to distinguish. See, the cost which they have already incurred, 16, right? This is already spent amount. And further, they are going to spend how much? This 18 is yet to be incurred. This will be incurred in future. This has been done, 16 has been done, and this is yet to be done. This much amount, expenditure. Estimated cost of completion means yes, yet to be incurred. So what happens? The total cost is 34. The sum of these two is 34. And profit is expected. So if you compare this 34 with the 40 million revenue, 6 million profit is expected. So out of the 6 million profit, you can recognize 45% right now. Right? So according to this, I'll be recording the revenue and cost. So the revenue that I will be recognizing, sorry, we're doing question number 16. Move back to question 16. So the revenue that will be recognized should be 40 million the full price multiplied by 45%. This is 18 million, and the cost that will be recognized will be 45% of the full cost. The full cost is 16 plus 18, 34 multiplied by 45%. 34 multiplied by 45%. This is the cost. So this is the amount that will be recognized, which is 18 million and 15.3 million. So the correct answer is D. So this is how we do it, and you can check the percentage of profit as well over here. So if you check what is the profit which has been recognized, just check the profit. So the profit is 18 minus 15.3. This makes 2.7. Now you can divide and check the percentage. Percentage is 2.7 divided by the 6 million profit. This should give you 45%. So this gives you 45%. So revenue cost both 45% and the profit is also 45%, right? So that's the correct answer. So okay, students, let's move on to the next question. Okay, the next question we are doing, let me first do some questions from various places, then we will come back to the other questions. So I'm moving on to another question, and that's a case. This question 21 to 25. Let's do this one. This is the last question for today, and then we'll continue tomorrow. Now, see students, it looks like that we are going a bit slow, but we are not slow because there are many upcoming topics which are much more descriptive and theoretical in nature. We won't be having much calculations over there, so they will be done faster than these questions which include a lot of calculations. That's why the topics we have covered earlier are difficult as well, and plus these topics involve a lot of calculation. That's why we are taking some more time over here. So inshallah, we expect that in tomorrow's class we'll be doing some simpler work and more theoretical work in which we'll take lesser time. So we'll be doing more questions in tomorrow's class. And also in the day 4 and 5, I've kept some less work so that the leftovers from the first, second, and third day will be covered in the fourth and the fifth day. So okay, so let's continue, students, with these questions 21. Now, what do you say in the question 21? This is about contract 1. So let's look at contract 1. The progress of work is 80%. And the price is 10,000. So what they're asking, what revenue should be recorded in relation to contract 1? So what revenue you need to record in this case in question 21? So it's very simple. The revenue to be recorded is 10 million multiplied by 80%, the progress of work. So the correct answer is 8,000. I'm writing because you have to mention in thousands. And how do I arrive at 8,000? It is 10,000 multiplied the progress of the work, which is 80%. Now, as 80% work has been completed, the company has provided 80% services to the buyer, so they can record this much of amount, which is 8 million. So the correct answer is 8 million. Okay, moving on to the question number 22. What cost of sales should be recorded to the nearest thousand in relation to contract 2? So what cost of sales is required in case of question number 2? Okay, this is a bit technical one. So in this case, just check. Remember, this percentage of completion method is used only in case when profits are expected. Let me write it down. The percentage of completion method using this 80%, 45% percentage is applied when profits are expected from the contract. If loss is expected, the prudence concept will be applied. And loss will be fully recognized when expected. So in case of losses, we won't wait for the percentage of completion. We will recognize full loss immediately. Okay, so in this case, see, let me make you analyze the situation. Loss is expected in contract 2. Just check. In case of contract 2, what cost has been incurred to till now? 4,000 has been incurred till now, and 6,000 is further to be incurred. So the sum of these two is 10,000. The sum of cost is 10,000, and the revenue expected is 8,000. So the revenue is less than cost. So 2,000 worth loss is expected. So loss needs to be recognized immediately in this case. So what happens? How will we account for in this case? So in this case, what we will do, cost till date is 4,000, and estimated cost to complete is 6,000. Right? So the total cost of the contract is 10,000, right? But the price is 8,000. So what needs to be done? Loss expected. So loss expected is 2,000, which needs to be recognized immediately. So how we will do it? Revenue will be recognized on the basis of percentage of completion. So revenue will be recognized on the basis of completion, 8,000 multiplied by 60%, which has been completed. So the revenue will be 8,000 multiplied by 60%, 4,800. And what about the cost of goods sold? So in case of loss, the cost of sales will always be a balancing figure, right? This will be a balancing figure, cost of sales, which they have asked in this question. So you are bound to recognize all of the loss. So you will recognize the full loss. You cannot recognize the 60% of the loss, as you will be following prudence concept. So the loss amount is minus 2,000, right? So what should be the cost? The cost will be 4,800 plus the loss. So loss is always incurred when the cost exceeds the revenue, right? So if you need a 2,000 loss, you have to record the cost more by 2,000 than the revenue, right? So 4,800 is the revenue, so I'm recording the cost more by 2,000. So this makes minus 6,800. So there's the answer in the red. So 6,800 is the correct answer. So the correct answer to this question is D. So expected losses shall be recognized immediately, right? So students, I feel this is all for today. We'll continue with the next other questions tomorrow. We have done till 22. So see you tomorrow. Thank you very much for attending from the session from so far away and being with me. It was a pleasure being with you people. Thank you. See you.